Welcome back to Gold Rush Reporter, your trusted source for real talk on gold, silver, and everything the mainstream media won't tell you. I'm your silver analyst, and today we're cutting through the noise to expose what's really going on with silver's underperformance, and why it might not stay that way for long. Silver should be shining right now. Global demand is through the roof, industrial use is at record highs, and yet the price remains flat. Why? Because the biggest concentrated short position in COMEX history isn't held by retail investors. It's controlled by just 8 Western institutions. And the cracks in their system are finally showing. Before we dive deep, let me ask you this. If the BRICS nations are patiently standing for physical delivery while the West keeps trading paper promises, who's really in control of silver's future? Let's break it down. For the past 2 years, analysts like Schectman have been warning that the power dynamic in the silver market is shifting. The Western financial system, dominated by institutions like JP Morgan, HSBC, and Standard Chartered, has kept prices suppressed through a massive paper short position on COMEX. These aren't just minor hedges. This is the largest coordinated short bet in the history of the market. Meanwhile, the BRICS nations, Brazil, Russia, India, China, and South Africa, are quietly standing for physical delivery month after month. They aren't interested in paper silver. They want the real thing. And as a result, the London Bullion Market Association, LBMA, is now reporting the lowest silver inventories since records began. This isn't normal. Nearly 59,000 gold contracts have already been traded this month, with over 5.8 million ounces delivered on COMEX. That level of delivery simply doesn't happen in a healthy paper market. It's a sign that major players are calling the West's bluff. They want metal, not IOUs. In theory, COMEX was never meant for large-scale physical delivery. It was a platform for contracts, not for vault withdrawals. Yet now, we're seeing delivery numbers that would have been unthinkable just a few years ago. That shift alone tells you something major is happening behind the scenes. And here's where the story gets more serious. According to Schectman, this tug-of-war between physical and paper silver is pushing the system toward a tipping point. As BRICS nations demand delivery, Western banks are being forced to cough up real ounces. And the supply simply isn't there. The data backs it up. The LBMA's available silver continues to hit record lows, and COMEX is being drained month after month. These withdrawals are not small. They represent the quiet exit of wealth away from paper markets into tangible metal. So, when people say silver is underperforming, they're only looking at the price, not the battle behind it. The truth is, the world's most powerful financial institutions are suppressing that price intentionally, while the East patiently drains their vaults. This could be the early stage of something massive, a full-blown reset in silver's price discovery mechanism. Next, we'll break down exactly how this manipulation works, the Western banks behind it, how they profit, and why the BRICS nations are methodically dismantling their control from the inside out. The deeper you look into this, the clearer it becomes that silver's underperformance has nothing to do with a lack of demand and everything to do with a long-standing, deliberate strategy by Western institutions. For decades, a handful of major banks have dominated the COMEX silver market through highly concentrated short positions. These positions are so large that they effectively control the market's direction. Instead of reflecting supply and demand, silver's price reflects the will of these institutions, and their agenda has always been to keep it down. Schectman and several other precious metals analysts have pointed out that this kind of suppression benefits one group above all others: the Western financial and industrial complex. The military-industrial sector, in particular, relies heavily on cheap silver for advanced technology, from weapon systems to aerospace applications. If silver were allowed to rise to its true market value, the cost of these technologies would skyrocket. Keeping the price low serves their interests perfectly. JP Morgan, for instance, was fined over $900 million by the Justice Department for manipulating the silver market, the largest such fine in US history. Yet despite that, JP Morgan remains the custodian of the world's largest silver and gold ETFs, SLV and GLD. Think about that for a moment. The same institution that was caught manipulating prices is now trusted to safeguard the largest physical silver trust on the planet. That contradiction alone should make anyone question how deep the system's corruption runs. And it doesn't stop there. BlackRock, another financial giant and one of the world's most powerful investment firms, is also deeply tied into this network. Not only is BlackRock one of the main custodians of SLV, but it also holds massive stakes in defense contractors, companies that produce everything from stealth bombers to missile systems. These firms all need silver in huge quantities. When you connect the dots, it's not hard to see why both JP Morgan and BlackRock would have a vested interest in keeping silver's price artificially low. According to data from COMEX, there's currently an 81 million share short position in SLV, an enormous figure that directly impacts silver's paper price. These are synthetic positions, essentially printed shares, with no real silver backing them. That means the actual supply of physical metal doesn't match the paper promises being traded. It's financial engineering at its most dangerous, and it's what allows these banks to maintain control over silver's price. Now, here's where things get interesting. The BRICS nations have seen through this game. They're not playing along anymore. Instead of buying into paper silver, they're standing for physical delivery, taking real metal out of the system every month. That's why COMEX and the LBMA vaults are showing record low inventories. This is the start of a slow but powerful drain of Western silver reserves. Once those vaults run dry, the manipulation ends, because you can't short what doesn't exist. This slow-motion standoff between East and West is reshaping global finance. Every ounce of silver delivered from COMEX weakens the Western financial machine just a little bit more. And every BRICS purchase of physical silver strengthens their control over the real market. It's an invisible tug of war, paper versus physical, illusion versus reality. The mainstream media refuses to discuss this, of course. They talk about silver's disappointing performance, or call it a volatile commodity, but they never address the structural corruption driving the price. The truth is, the manipulation can only continue for as long as the West controls enough metal to meet delivery demands. Once they can't, the system collapses under its own weight. What's happening right now in the silver market is much bigger than just price suppression. It's part of a quiet geopolitical war over financial power. The BRICS nations have recognized that the Western banking system's control over commodities is built on paper promises, not real assets. And they're methodically exposing that weakness by demanding physical delivery, month after month. This is not a random trend. It's a deliberate strategy to weaken the US dollar's influence and force a global revaluation of precious metals. For decades, the West has used its dominance of the COMEX and LBMA systems to project financial control. These markets were designed to trade futures contracts, not physical metal. By keeping the system largely paper-based, Western banks could inflate supply, create artificial price pressure, and dictate market perception. But BRICS has flipped the script. They are turning the COMEX against itself by forcing actual delivery on contracts that were never meant to be fulfilled. This shift is now visible in the data. COMEX deliveries are climbing, LBMA vaults are being drained, and for the first time in modern history, large portions of metal are moving directly to Asia. China is the biggest player in this game. They're not just importing refined silver. They're buying raw materials straight from miners in Latin America, Peru, and Mexico, even paying higher premiums than Western buyers. They're purchasing door bars, unrefined silver, and processing it themselves. That's how serious they are about securing real physical metal. When a nation like China decides to pay more than the market price to get silver, it tells you everything you need to know about where the real value lies. They know this system is nearing a breaking point. For years, silver supply and demand estimates have conveniently ignored military and industrial consumption. The reality is that the global military sector alone consumes over 200 million ounces of silver annually, and that's a conservative number. When you include the energy transition, solar panels, electric vehicles, and 5G technology, the gap between actual demand and reported supply becomes massive. The Western response has been predictable. Continue suppressing the price to maintain the illusion of control. Standard Chartered, HSBC, and others have likely been instructed to keep a lid on silver's rise to avoid triggering panic. But that strategy is running out of road. The available metal is shrinking fast, and every time BRICS demands delivery, more of it disappears from Western vaults. Analyst Keith Neumeyer from First Majestic Silver has warned for years that this imbalance can't continue. He's repeatedly pointed out that while gold and silver historically traded at a 16-to-1 ratio for thousands of years, today that ratio sits near 85-to-1. That isn't a reflection of reality. It's a reflection of distortion. If silver were allowed to trade freely, it would likely be several times higher than its current price. Meanwhile, the Western financial complex is in denial. They're using every trick possible to delay the inevitable, extending delivery times, citing logistical issues, and even blaming staff shortages at the Bank of England to explain why metal isn't being moved. But none of those excuses change the truth. The physical silver simply isn't there in the quantities the paper market pretends it is. Every sign points to a slow, calculated unraveling of Western price control. The BRICS nations aren't trying to crash the system overnight. They're bleeding it dry. The more physical metal they accumulate, the more leverage they gain over future price discovery. Once the West runs out of deliverable silver, the entire paper structure collapses. And that's when things get dangerous. A failure to deliver on a major COMEX or LBMA contract could trigger widespread panic across global markets. If investors realize the vaults are empty and the paper claims can't be honored, confidence in Western financial integrity evaporates overnight. The ripple effect wouldn't stop at silver. It would hit gold, currencies, and even sovereign debt markets. The deeper we move into this crisis, the more it looks like the Western paper-silver system is running on borrowed time. Everything that once held the illusion together, trust, liquidity, and available inventory, is fading fast. Andy Schectman calls this the slow bleed of credibility. For years, Western institutions could manipulate price through leverage and synthetic exposure, but that trick only works while they still have metal to deliver. Once physical supply tightens, the system breaks down from the inside. We're already seeing the warning signs. The London Bullion Market Association's vaults are reporting record low silver reserves. COMEX inventories continue to fall, and the number of contracts demanding physical delivery keeps rising. That's not a coincidence. It's a pressure buildup. BRICS countries are quietly draining the vaults while Western banks scramble to maintain appearances. The longer this tug-of-war continues, the closer we move toward a delivery failure that could reset the entire silver market overnight. When that happens, the paper price won't matter. The only thing that will count is who actually holds physical metal. If you have it in your hand, you're safe. If you're holding paper promises, whether that's SLV shares, futures contracts, or unallocated accounts, you're exposed to the same risk as the big banks. Counterparty failure. Let's be blunt about what's really going on. The Western financial system has been selling metal. It doesn't have to fund a machine that keeps governments, militaries, and megacorporations running. Institutions like JP Morgan and BlackRock are at the center of this structure. BlackRock owns significant stakes in weapons manufacturers, companies that depend on massive amounts of silver for advanced military technology. Keeping silver cheap keeps their costs low. It's not about market efficiency, it's about protecting the profits and power of the system itself. But BRICS has changed the equation. By standing for delivery, they're essentially saying, we see your paper game, and we want the real thing. Each time a delivery is made, a piece of that illusion dies. That's why the West has started extending settlement times, claiming logistical issues, or blaming labor shortages in London for delays. These are excuses designed to buy time. But time is running out. If a major Western bank or vault fails to meet its delivery obligations, the fallout will be immediate. Confidence in COMEX and LBMA would collapse, and the ripple effect would hit every derivative tied to precious metals. That includes ETFs, futures, and even currency markets. A single failure could trigger a chain reaction that redefines what price discovery really means. The BRICS nations are already positioning themselves for that outcome. They're accumulating physical gold and silver at record pace, building alternative settlement systems, and preparing to back parts of their trade network with tangible assets. Once their systems are ready, they won't need Western pricing mechanisms. That's when silver's true value will re-emerge, outside of paper control, dictated by real supply and demand. For ordinary investors, the lesson is simple. The system won't warn you before it breaks. You'll wake up one morning to find that delivery times have doubled, premiums have exploded, and physical inventory has vanished. By then, it'll be too late to act. The time to position yourself is before the reset, not after. What we're witnessing right now isn't just a price anomaly or a temporary imbalance. It's the unraveling of an entire financial illusion. The Western paper system built on leverage, short positions, and false promises is being exposed by something it can't control anymore: real, physical demand. Silver is the pressure point of this system because it's both a monetary metal and an industrial necessity. When nations like those in the BRICS alliance start demanding physical silver instead of paper, they're not just buying metal. They're pulling the plug on decades of Western dominance. As Andy Schectman and other industry veterans have said repeatedly, this is the final stage of a long game. The West has been exporting real wealth in the form of metals while importing debt, inflation, and digital promises. That trade worked when everyone believed the system was stable, but that belief is fading fast. Once the BRICS settlement networks are fully operational and backed by real assets, the US dollar's monopoly on global trade is finished. At that point, silver won't just be a commodity, it'll be a geopolitical weapon. The reclassification of silver as a critical or essential mineral by multiple governments is a warning sign of what's coming. When bureaucrats start labeling something as essential, it's because they know shortages are real. Silver's role in solar panels, semiconductors, and defense technology makes it one of the most strategically important materials on Earth. Combine that with monetary demand from central banks and investors, and you've got a setup for a supply shock that could send prices far beyond what anyone expects. And here's the brutal truth: most people still don't see it. They're distracted by short-term moves day-to-day volatility and clickbait headlines. They think silver is boring because it hasn't exploded yet. But once the system finally breaks, there won't be time to react. Premiums will skyrocket, supply will vanish, and the mainstream narrative will flip overnight. From "nobody wants silver" to "why didn't we see this coming?" That's why this moment matters. It's not about hype, it's about preparation. When manipulation ends, repricing begins. The winners will be those who understood the game before everyone else, the ones holding real metal, while the rest of the world holds empty promises. If you've followed this series closely, you already know where the trend is heading. The question now isn't if the reset happens, it's when. Silver's true price will emerge in a market that values substance over speculation, and that shift is already underway. Thanks for watching, everyone. You've been tuned in to Gold Rush Reporter, where we cut through the noise and bring you the truth about gold, silver, and the global financial reset. If you found this breakdown helpful, make sure to like, share, and subscribe. And don't forget to hit that bell icon so you never miss the next deep dive. Until next time, this is your Silver Analyst signing off. Stay sharp, stay informed, and keep stacking.